Gold has been on a tear this year, but black gold, on the other hand, has not shared the same fate. Oil is down about 17% year to date, and natural gas is a linked but totally separate thing, and it's actually up. And there have been a lot of very interesting macroeconomic conditions that have made this divergence in the two power sources. And I'm really excited to get into, the nuances of it today, because there is a lot going on here that doesn't get super widely publicized. But like it or not, petroleum-based energy is a cornerstone of our world.
Absolutely. I think as much as we've seen the pivot to green energy and electrification, oil and especially gas, and we'll talk about the dynamics of both of those, are incredibly important to our economy as a whole. And first, I want to focus on oil markets. So we'll separate oil and gas, really focus on oil, first of all, and of course, the downstream parts of that, including gasoline. But for oil, I see three primary drivers of that market right now. And unfortunately for, oil companies, most of those are negative, or really pretty broad based, have negative implications. And the first one, at least for oil prices, I'll make that note. And the first one's the drill baby drill mentality of the Trump administration, really ramping up supply and production in the United States. The second being OPEC plus, their production cuts and what's coming forward, the production increases they expect to have. And then three, the expectation of economic and shipping slowdown generated by tariffs. All three of those things put downward pressure on oil, which for oil companies, not so good, has some good benefits for consumers and companies, but I want to get into all of that today.
Well, I'll take the first one there. And this drill baby drill mentality is something Donald Trump's been talking about since his campaign started, even before his campaign, is the allowing American companies can lead the charge in producing more oil, driving down those oil prices for consumers. That's actually part of the goal, is not only be friendly to the oil producers and allow them to do what they do best, cut the red tape, cut regulations, allow them to drill, but also in order to, have that feedback of lower prices for consumers. And while it works in conjunction with what you were talking about to the international supply, because oil is a very international market, but WTI is the West Texas Intermediate. It's a crude oil marketplace, has dropped below $60 a barrel recently. And we don't generally see US producers, specifically the ones in the Permian Basin in West Texas, they don't really drill new wells below $60 a barrel because the return on investment isn't there anymore. You've seen a lot of that production increase, but we're kind of on the trail end of that because oil prices drop so much.
Right. And I think the interesting part of that, because the permitting and licensing for these wells has gotten a little bit easier, I think we are likely to see a lot of well starts over the next, call it 3.5 years at this point, because these oil companies see an opportunity. They can go ahead and, poke holes in the ground, and then they can cap those wells or not complete them until oil prices really get to a higher level, because no company in the upstream oil space, and to kind of break down the oil verticals, I'll just give that to our audience, is upstream oil and gas, meaning bringing that oil out of the ground. So those are the drilling companies that are producing oil out of those wells. You've got the midstream companies that are transporting that oil and gas. And then you've got the downstream companies that are refining the oil and also distributing the end products like gasoline to your US consumer. So getting back to those upstream producers, they're not really interested when oil prices are below 60 to really be ramping up supply. So you've kind of reached this, you may want to call it an equilibrium point, where your oil prices are so low because production internationally really has ramped, but you're not going to see increased supply from here necessarily, especially out of the United States, because oil prices are so low. There's just not a lot of interest. So you've got those kind of competing factors driving the current market for those upstream oil companies. Now, if we want to pivot internationally, OPEC is a very interesting dynamic. They've been undergoing voluntary production cuts, so they could potentially be producing more oil, but they've intentionally brought that down, creating, a cap on how much each country within that, energy cartel is allowed to produce in order to maintain higher oil prices. Well, what you're going to kind of get to is that it's really hasn't benefited them so much, especially now that oil prices are lower despite what they're trying to do.
I think it's really important to call out here specifically that OPEC and OPEC Plus don't have the same power over the oil markets and oil prices in general as they used to. They used to produce, the majority of oil in the world. It was OPEC Plus, and America, essentially. But in recent years, you've had so much more production come online throughout Africa and places like Guyana, and America itself has grown a ton. So OPEC, through their voluntary cuts, can have effects on oil production and oil prices, but not to the same extent that they have historically been able to, drive the price up if they want to. They've been reducing or cutting their production for the past couple of years now. And that hasn't really seen a durable increase in oil price, to at least not to the levels that they want it to be at. And so Saudi Arabia specifically has kind of said, we tried. And so now they're pumping oil for really two big reasons, is because oil prices have remained and gone even lower, due to, Guyana, Africa, America, but also other OPEC plus countries who have been cheating their quotas. We've seen that out of Russia, who at this point is looking for every dollar that they can make, in really what they have to sell as oil, to fund their war. And so they've been skirting their quotas, and, places like Iran, they've been skirting theirs as well, because they have been funding their own things. And so all of these countries have been overproducing, and Saudi Arabia has been really leading the charge in cutting their production, as well as they're the biggest OPEC member. They're kind of the leader of that cartel. And if no one else is going to abide by the rules, they still have one of the lowest costs of production out of anyone. And so they can survive at low oil prices. And so they've kind of just gone ahead and said, so be it. And, almost declared economic war on the rest of OPEC and these other countries.
Exactly. And I can't remember if we mentioned this on one of our more recent or past oil and gas podcasts, but we've talked about this a lot around the office. And I remember bringing up, hey, this is the downside risk, is that OPEC and specifically Saudi Arabia says, hey, we're tired of the rest of the world producing so much. We're tired of these OPEC members skirting the rules and overproducing. We've got some of the cheapest production in the entire world. We can basically poke a hole in the ground and oil is going to start flowing out of it. So we can bear the brunt of lower oil prices for a certain period of time. And they use that oil revenue to fund their government, to pay their people, to, run their entire society. So, if prices are lower, they're going to kind of have to increase supply because their margins are smaller in order to get the same number of dollars flowing. So I do kind of look at it as the revenge production movement, and they haven't ramped to their full capacity yet, but they already said that they're going to ramp production, I think 400,000 barrels per day, with the anticipation of that increasing further as time goes on. So it's gonna be really interesting to track how that develops over the coming months.
Yeah. And for reference for our listeners, global oil production is a little over, but right around 100 million barrels per day. So it makes it really easy to work on percentages of world production. And Saudi Arabia can easily increase, like you're saying, they're increasing 400,000 barrels a day, but that can easily be 1 million barrels per day and add a whole percent onto, the world stage, and potentially way more than that. So that's, something to keep an eye on as we move forward, because Saudi Arabia makes up such a large percentage of the world's, oil supply. And then turning to oil demand, we have economic uncertainty that's really driving prices down. And this is kind of a longer term, like oil futures and, what oil investment looks like today. But it's a reduction of trade globally and internationally can really put a big damper on oil prices. You're talking about shipping goods across the world, from China to America, from Europe to America, just all over the place. And then once they get on shore, all those trucks taking those goods everywhere they need to go. If that trade stops, that's a huge reduction in the amount of oil and particularly gasoline that gets used globally. And so anytime there's a macro pullback, we saw this in COVID, people stopped traveling, people stopped driving. People were still ordering things during COVID. This is kind of the opposite. People are still going to be taking their road trips, but not ordering so much because cost of goods are so much higher. Well, you're not using oil like you were previously, and that puts a big damper on oil demand.
Yeah, and from a recent podcast that we recorded, you had mentioned that container shipping from China specifically had dropped, something like 40% in the month of April. And so much energy is used in that international shipping ecosystem. You mentioned trucking rates, even within the United States, have already started to drop. And that's just a result of less demand for trucking. So that means fewer gallons of gasoline and diesel being used, fewer barrels of oil being, utilized for that. So when you get to the macro of it, you've got the combination of lower demand and increased supply. And, if we bring it back to Econ 101, what does that mean? Well, price is going to drop. And that's why we've really seen WTI crude oil drop below that $60 mark, creating a pretty tough environment for those oil operators.
And something I want to call out before we move on to natural gas is that WTI is the American Oil Exchange, and you have Brent crude being the British, but really European oil level. And those are generally, a couple dollars different. WTI being a couple dollars, $2, $3, sometimes $4 cheaper than Brent, but pretty much in line, like pretty close. All in all, natural gas is a very different story. Natural gas in America is currently about $4 per million BTUs. It's an interesting metric, but just call it $4 natural gas. And it's over $10, even about $11 in these international markets. So that creates a hugely different dynamic when we're talking about, natural gas drivers than it does for oil drivers. And there are some positives and negatives on natural gas. Like I mentioned at the top of the episode, the price of natural gas has increased about 23% so far this year versus oil's decrease in 17%. So very opposite move here. And the demand driver primarily being, energy production. There's been a lot of electrification throughout the world of EVs, more data center utilization. Also, industrial electrification is a big and growing trend, as well as our ability to ship LNG. So by liquefying this natural gas and shipping it internationally, we start moving more closer to the oil paradigm of similar oil prices throughout the world. Right now, companies can arbitrage those prices, liquefy it in America at $4 and sell it internationally at 11. So that's a huge driver, something that we've seen growing more and more recently.
Yeah, and I think the natural gas market is interesting, and why we're really more bullish natural gas. You outlined it perfectly right there. And it's that's what's really driven that natural gas price increase, is the fact that unlike oil, you have more positive indicators of demand, and fewer indicators of increased supply. There is more drilling activity, which leads to more natural gas. But the interesting thing about natural gas is that it has to find end markets, which is what you're talking about. It's much more dislocated because it's not quite as stable and easy to transport as oil. Oil, you can put it in a drum, it doesn't need to be pressurized. Whereas natural gas, you can ship it through a pipeline across the country, or you can super cool it, put it in an LNG carrier, and then ship it across the ocean. But that's much more difficult than oil that can be pretty easily transported. I mean, obviously, I could throw some barrels of oil in the back of my pickup truck if I wanted to, but I would have no way of transporting natural gas other than, something that's a liquefied, like propane or something like that, doesn't have a huge international market and isn't efficient. So I think that's really important to understand when it comes to the dynamics of these markets. And the US, based off of where the production is located, also plays a big role in that. A lot of the Northeast natural gas is what's being used when it comes to LNG. You've got places like the Marcellus Shale in the Northeast that produce a lot of natural gas, but that finds pretty good end markets, whether it's energy generation for cities in the Northeast, or if it's shipped out via LNG. But you also have a huge amount, we were talking about upstream oil in the Permian Basin in Texas, that really isn't able to find end markets. And so that's why natural gas prices are extremely low in the Permian, because there just aren't that many sources of supply sources of demand soaking up that supply. So you have these really interesting, dislocated markets, and it's going to take a lot more midstream, a lot more LNG shipping capabilities to stabilize those prices, even within the country of the United States. I mean, you were just talking about internationally, but I think it's important to realize that natural gas just has a more difficult dynamic when it comes to transportation that oil doesn't really encounter.
That's a great thing to call out, because I didn't really mention even within the country, but you have the $4 to $11 differential between the US Henry Hub that's in Texas and international markets. But you also have the difference between Waha Hub, which is the one in the Permian, and Henry Hub, because even though there are pipelines connecting it, there's not enough throughput for all of the gas that's pulled out of the Permian. Because Permian is very interesting because there's a lot of easy to access oil, but it's also very gassy oil. So you get a lot of natural gas just as a byproduct of drilling. And due to EPA and flaring restrictions of just burning it as they have in the past, now that that's restricted, you have prices at the Waha Hub of $0 a lot of the time, and even going negative for a material number of days per year if you're trying to sell that natural gas into the pipeline, because there's more supply than they can get rid of. And so people, because they get fined huge amounts of dollars by the government if they flare it, they have to sell it for a loss. They're selling it at negative prices so they can get rid of it legally into the Waha Hub. So you're talking literal negative gas prices in the Permian Basin of America, and $11 plus in international markets. So just that midstream and that transportation is such a big point of consideration and growth that needs to happen. Don't have the infrastructure like you do for oil. And so that's talking about, like you said, midstream, getting that gas to the coast so it can be liquefied, and then liquefied. That's a whole battle in and of itself, and then shipped internationally. And that's something we saw in the previous administration, that they were cracking down on, new LNG facilities, not allowing that liquefaction so it can reach end markets. That was primarily in the name of being more green. But I think natural gas at this point is something that we're going to be living with for a very long time, even, in my opinion, longer than we live with a huge reliance on oil, just because it's, economical. There are a lot of reasons that I don't want to spend too much time getting into, but it's going to be part of our lives for a long time. So the Trump administration's made it a point to allow more liquefaction of this natural gas to be sold into end markets internationally. And that's especially important for Europe right now, because Europe used to get almost half of its natural gas supply from Russia. And there's a huge pipeline coming straight through into middle of Europe. And so they'd use that to heat their homes throughout the winter, along with all of the other, common uses. But home heat is one of the largest uses of natural gas in Europe. And they've been making lots of steps after Russia's invasion of Ukraine to reduce their reliance on Russian natural gas, but they can only do that so fast. Part of that is setting up LNG import terminals, which they have. And so now they're able to accept our natural gas if we can get it over there. And so just to put some numbers behind this, previously in 2021, Europe bought 45% of their natural gas from Russia. So really almost half. It's estimated to be only 13% of their imports in 2025. And they're trying to go totally to zero by 2027. And that needs to come from somewhere. Right now it's coming from, the Middle East and America, but Donald Trump's been making a lot of steps to try and, get American natural gas over to those end markets because it makes a lot of sense. We have plenty of it and we can, help Europe and America at the same time.
Right. And that's where you need, to your point, you need the greater LNG infrastructure. You need companies like Cheniere to boost investment, to create more export terminals, to find those end markets. And I think this kind of goes beyond the scope of the episode, but I think it's worth mentioning is that as we're negotiating these trade deals, if you're looking for more balanced trade, I think natural gas could become a big piece of this. We've already heard some whispers from the Trump administration that they want these international economies to buy more natural gas from the United States. Well, right now we're shipping out everything that we really possibly can. So what we're going to have to do is ramp that, domestic infrastructure because it's much more difficult to create the infrastructure to cool down and compress, natural gas into liquefied natural gas, put it on a boat than it is to create an import terminal. So companies can pop up these import terminals relatively quickly. You're just, decompressing the gas and letting it flow through a pipeline. Well, in order to get it cooled and compressed, that's a lot more infrastructure, a lot more capital and, construction intensive. But it seems like the administration wants to move in that direction. I think it could really play into these trade deals that are moving forward. And I think natural gas, even if you're trying to move away from, call it petroleum products, it's still going to remain extremely important. We mentioned the electrification of all things and data center energy demand. Well, some of the fastest energy production that you can pop up are natural gas generators. And because it's quick, relatively cheap, and it has extremely good uptime on those facilities. So I think that's going to be a continued demand vector for natural gas and is going to play an important part in helping the electrification of the United States, international economies, and really, frankly, the world. And I think the US can be kind of the new Middle East of, equivalent of what oil has been historically, the equivalent of the Middle East when it comes to natural gas exporting. And I think that could be really fascinating and something we really could see develop over the next 5 to 10 years.
Absolutely. And, one more pro for natural gas being that not only is it quick, reliable, relatively cheap, it's also considerably greener than a lot of the, electricity production that we have at hand. There are still coal plants in this country and all over the world. And to set up natural gas, even just to replace that coal, is a net benefit to the world. So it's not the, optimal final destination for energy, but it's a good intermediate step that can, serve as a springboard into greener things. If, for people who are concerned about that, it's a better option than a lot of what we've had now. It doesn't face a lot of the timing and interruptibility challenges that current green energy has. So that is one of the core reasons I believe natural gas will stick around and be a big cornerstone of, the world's energy sources for a lot longer time than perhaps even oil is. But to get off that soapbox, move kind of broad takeaways here is it's still a tough environment for oil producers, and it's going to remain one for a while. Like you mentioned, even in the US, there are a lot of drilled wells or mostly drilled wells that are capped and can easily be turned on and get those barrels of crude flowing if the price goes back up. So there's a lot of that capability of production if we start seeing price inch up past 60 into the mid high 60s. I think you're going to start seeing a lot of that come online. So I think that's going to keep kind of a cap on crude prices for really the medium term, at least the short term, until we see some more either demand drivers or change in OPEC. Again, midstream should benefit from this. They're moving a lot of barrels of oil and natural gas. Yes, there's a reduction in demand, but with cheaper oil comes higher usage of oil, and so oil usage is what really helps the midstream players. And so whether that's natural gas, especially natural gas, or even oil, you're going to would expect to see midstream players do fairly well in that kind of environment.
Yeah. And then finally, to get that last vertical in there, I think downstream, we haven't really talked about downstream a lot in this podcast because everything kind of flows downhill, right? So it starts at the top, and what are the dynamics up here, the broad macro, and then how does it relate to the players down the line? Downstream producers, they're making spreads on what they can refine the crude oil into, and the end products like gasoline and jet fuel and things like that. The spreads on those products have actually remained fairly attractive. They haven't dropped a whole lot considerably. So they're going to be just fine. I mean, typically your downstream operators are vertically integrated. So they really cross across, upstream, midstream, downstream. Those are like your Chevron, Exxon, your super majors of oil and gas. So I don't have a major call on them. I think they're getting hit by the broader just oil economy in general right now. But whenever it comes to us from an investment standpoint, I think we can agree that we're certainly more bullish on the natural gas side, the LNG side. The dynamics for natural gas are interesting because you are trying to balance the increased production of oil and gas within the United States and the demand sources like the electrification, the energy demands, LNG exports. But we're certainly bullish on the LNG export side because the demand is there. Like you said, there's that arbitrage between prices in the US and internationally. So if you can create an export terminal or you have shipping vessels that can transport that LNG, you can make that spread. And that's a really attractive market. It's just a matter of how quickly can you get that infrastructure in place to do it. And then really to take it home, to kind of give a broad macro picture, because we're always looking at the macro when it comes to broader markets. I think lower energy prices in general, especially on the oil side, and then trickling down to gasoline, is going to be a benefit for businesses and consumers. We're talking about tariffs a lot lately and how that's going to increase prices for consumers. Well, decreased oil prices do take up a considerable amount of wallet share, via just your normal fuel expenses on a day-to-day and week-to-week basis. So being able to offset some of that with lower fuel prices is very positive for the consumer, for businesses that rely on shipping costs. So I think that's going to help counterbalance the other macro trends that we're seeing right now, and kind of gives a little bit more confidence when it comes to the overall inflation picture that businesses and consumers are seeing.
I think that's a great thing to call out too, is the Fed and inflation side of things, because that really helps serve to Donald Trump's point to bring inflation down, get some rate cuts going. The tariffs have not helped that argument, but from a broad inflation and, like you said, wallet share, really just to keep a strong consumer, this is a really positive thing for them. So we'll see how it pans out. And I know there's a lot of stuff going on in oil and gas market, some very interesting dynamics. And so I'm really hoping that for our listeners, this provided a good summary, good overview of everything that's going on right now, because it is a really interesting space.
Absolutely. Hunter, thanks for joining me today.
Yeah, thanks, Victor.